On the same day, the S&P/ASX 200 posted its fourth consecutive loss. BHP Group reached a new all-time high of $62.30. That is not how down sessions are supposed to work. When a benchmark falls 4 days straight, and its largest ever single-day bank decline happens simultaneously, the stock that rises to a record is supposed to be a safe haven, not a mining giant leveraged to global commodity cycles. Yet BHP's market capitalization crossed $303 billion on Wednesday, surpassing Commonwealth Bank's $287 billion at its worst point of the day. The market cap crown changed hands in real time, not at the end of a quarter. The backdrop deserves placement. The S&P/ASX 200 index opened under pressure after the federal budget. Treasurer Jim Chalmers' $18 billion spending increase drew immediate scrutiny, coming the same week the RBA's Michelle Bullock had publicly called for fiscal restraint. Overnight, U.S. April CPI came in at its worst reading in nearly 3 years, reinforcing expectations that the Federal Reserve will hold rates steady for the foreseeable future. The ASX financial sector collapsed 4.01%. Consumer discretionary gained 2.94%. Materials surged 1.97%. Those three numbers tell a story about where capital was moving, but they do not yet explain why it moved with such precision on this particular day. Commonwealth Bank reported its third quarter result. Cash profit came in at approximately $2.7 billion, slightly below market expectations. The share price fell just under 10% to $154.41, one of its steepest single-session declines in years. CBA's market cap dropped to $287 billion, and in the same hour that CBA was registering that loss, BHP was printing a new record.
The immediate explanation is commodity pricing, and it is correct as far as it goes. BHP's iron ore exposure benefits when global industrial demand signals hold up. The federal budget raised domestic spending. Materials names read that as pipeline activity. But that explanation stops too soon, because it treats the BHP move as a simple sector rotation, when the mechanism is more specific than that. The capital that left CBA did not simply rotate into banks elsewhere. It moved into hard assets with a critical minerals dimension. On the same session, tungsten prices were trading at US $3,185 per metric ton unit, up more than 300% since January. Arafura Rare Earth signed a binding offtake term sheet with Traxys North America for 500 tons per annum of neodymium praseodymium oxide from the Nolans project. Arafura share price rose 11%. Anson Resources gained 45% after POSCO confirmed a demonstration plant agreement for the Green River lithium project in Utah. These were not small-cap momentum trades in isolation. They were signals that the ASX materials complex is pricing a structural shift in who controls critical mineral supply chains. That is the condition that makes the BHP move difficult to read cleanly. BHP reached its record high on a day when the bank underpinning Australian domestic consumption fell by 1/10 of its value. If the BHP move reflects genuine global demand strength, that is one scenario. But if Australian domestic consumption is weakening, which a CBA earnings miss and a 4-day index decline both suggest, then BHP's record is not corroborated by the economic environment its domestic revenue depends on. The divergence between what BHP is pricing and what CBA is pricing cannot both be right about the near-term Australian economic trajectory.
The last time BHP held the market cap crown over CBA for a sustained period was during the commodity supercycle of the early 2010s. At that time, the divergence was driven by Chinese infrastructure demand that genuinely outpaced domestic Australian consumption growth. The current setup has a parallel structure in the critical minerals re-rating, but it has a different asymmetry. In 2010, bank earnings were not simultaneously deteriorating. Today they are, which means the BHP premium has less corroboration from the domestic economy beneath it. The resolution likely turns on two distinct variables. On the continuation side, if U.S.-China trade diplomacy produces a concrete framework for rare earth and critical mineral supply agreements, and Wednesday's Arafura Traxys deal suggests U.S. industrial buyers are already repositioning, then ASX materials names have a capital flow argument that is independent of Australian domestic consumption. The 500-ton NdPr commitment from Traxys is a concrete number. The question is whether it is a one-off or the first of a series that re-rates the sector ceiling. On the breakdown side, if next week's RBA minutes or retail data confirm that the federal budget's $18 billion uplift is not translating into consumer confidence, CBA's earnings miss may turn out to be a leading indicator for the material sector rather than an isolated banking story. BHP is not immune to an Australian demand slowdown.
The verification benchmark is the ASX 200 on the 5th session. 4 consecutive falls with a materials surge embedded inside them is not the normal shape of a broad-based sell-off. If the index finds a floor at the 8600 level and materials continue to outperform financials, the BHP record becomes a credible re-rating. If the index breaks through 8600 and materials names give back Wednesday's gains, then Wednesday's session was a crowded trade into the last standing sector, not a structural shift. The question that remains open: can BHP sustain a market cap premium over CBA without the domestic consumption base that justified CBA's crown in the first place? Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.